All right, people, in this practice, we're going to calculate several performance measurement for a portfolio. The portfolio we have here is a mutual fund called a Third Avenue. You can just Google search it, just to do mutual fund, Third Avenue, and you will see their website. So basically, it is a investment company established in New York City. It was founded in 1986, and they have different investment strategies such as global value, small cap, real estate, international real estate, and so on. So we have the data downloaded, and that's for this particular mutual fund from the year of 2018 all the way to the year of 2023, and the month is the following the year number. And so we will, first calculate the Sharpe ratio and then the CAPM beta, and based on which we do the trainer ratio. And after that, we will get the Jason's alpha, and then we will get the information ratio, and then we will calculate the Sortino ratio. All right. So we're gonna scroll down a lot for the calculations. So number one, let's just click right here, select all the data, and go to the View button and do the freeze panes. I want to freeze the top row. So when I just drag it down, I can see all of this. I can always see this title row being displayed. All right. And I don't need this. So let's just get started. So what we're gonna do first is to create the risk premium of the portfolio. So I just use RP to stand for the risk premium. Okay. So the portfolio basically is this mutual fund. You know, mutual fund covers a lot of securities like real estate securities, like stocks, and also some other kinds of equity securities. All right, so what you do here is pretty simple. You use the portfolio return minus the risk-free return, and you know risk-free return is the T-bills rate. Okay, and then you just double click, and then you can just go ahead and get the expected risk premium. Okay, the expected risk premium, let's say it should be the average of all this. Okay, all the risk premium. Okay, just to Control Shift down all the way to the last row, and then you hit Enter. And you can also calculate that as the average of the raw returns. Okay, these are your raw returns minus the average of the risk-free returns. Okay, you will get the same result. Okay, I forgot to put a parenthesis here, but you get the point. Okay, so you will get the same result as I did over there. So format Painter, and then you see the same exact answer. All right, and then you can calculate the standard deviation for the raw return of the portfolio. You see, this is the raw. Let me just put raw here, replace the name. And then to calculate standard deviation, it's a super duper easy with Excel. Just use the STDEV, and then you select all the returns, and then you have it. Okay, so the standard deviation for this portfolio is 8.82%. And then you can calculate a Sharpe ratio, and the Sharpe ratio is the expected risk premium divided by the standard deviation of the raw return. So I can't click here, but I can always type in as L2. All right, so this is your Sharpe ratio. And the Sharpe ratio is at monthly level because you are using monthly data to do it. And you can convert it to an annual Sharpe ratio. So how exactly can you do that? You just multiply this monthly ratio by the square root of 12. Okay, you have a 12-month in a year. So because the numerator of Sharpe ratio is the return, denominator is the standard deviation. So the math basically requires us to use a square root of 12 instead of 12. Okay, so that's your annualized Sharpe ratio. All right, the next thing you can do is to get the CAPM beta. Okay, the CAPM beta, and to get the beta, the easiest way to do it is pretty straightforward. You just use a slope function to get the portfolio risk premium and the market risk premium. So this is your portfolio risk premium. Oops, I need to get back after selection. I need to hit the comma instead of enter. And then the portfolio, the market risk premium is market return minus the risk-free rate. So this is your market, all right, market risk premium, and then hit enter. So that's your CAPM. That's the beta generated by capital assets pricing model, the CAPM. And the trainer ratio, you would need to use the expected risk premium divided by the CAPM, okay, which is your L5, L6 in this particular case. So that's your trainer ratio. Okay. And then you can calculate the alpha based on the CAPM, and also the alpha based on Fama-French three-factor model. Okay, so to do that, you will need to run regression. You need to first make sure this data analysis is successfully installed. If not, then you would have to go to Files, Options, and then you could go to Add-ins, not Trust Center, Add-ins, and then hit Go, and make sure Analysis 2-pack is checked. All right. So to do the CAPM, that's pretty simple. You hit Data Analysis under the Data tab, and you're gonna choose Regression. Okay, and then you will need to put the portfolio risk premium. Okay, and then the market risk premium. Okay, then hit enter. All right, so you would have this new spreadsheet generated. So this coefficient is your beta for the model, and this is your, and this one is your alpha. So you can just select this number, intercept, and also this coefficient. Select it and then copy to this page. Okay, so that's your CAPM beta. Actually, just this number. And you also need to run another regression analysis. So the y values would be the same as the portfolio risk premium. The x values actually are these three components. Okay, and then hit OK. So now you have three independent variables. So x1, x2, and x3. So you have three betas for the three factors, and this is your alpha for the three-factor model. So you can just copy and paste it right here on my French three-factor model. And I want you guys to observe the p-value here. So if you look at the p-value, it's pretty high. It's actually higher than 10% threshold. So that means this alpha is not significant. If you look at the other p-value of the other alpha, it is definitely way higher than 10% threshold. So this alpha is not significant either. So you can just put an insignificant. Because the insignificant, that means this mutual fund manager, whoever managed the third mutual fund, they do not have the extraordinary skill to generate good returns. They may have an average return that beats the market, but all because they invest in riskier stocks. So that's why their returns could be higher. But if you look at the alpha, those abnormal returns, they are insignificantly different from zero. So they are basically zero in plain English. So these are basically zeros. And that means the managers, they do not have above average skills to generate the abnormal return. Well, next thing we're going to work on is called an information ratio. And it is based on the expected excess return. So what is the excess return? It should be the portfolio return, your portfolio return, the portfolio return minus a benchmark return. Okay, just say benchmark return. And what would be the benchmark return? The information provided here, I think the market return would be the best benchmark for us to catch. So you're going to use the portfolio return minus the market return. So the columns here are including this market risk premium and the risk-free rate. And we know that market return is the benchmark return. And you also need to know that the market risk premium equals to the market return minus the risk-free rate. Okay, just call it risk-free rate. Therefore, the market return equals to risk-free rate plus the market risk premium. So let me just do market return here. So I will use market minus risk-free plus the risk-free, so to get the market return. All right, so I don't have that directly provided to you, I'm sorry, so we have to calculate that. And then you will get the portfolio return. We call this excess return, which is a portfolio return in excess of market. Okay, so you have the raw return for the portfolio minus the market return. Okay, so this is your excess return for the portfolio. All right, and then you are going to conduct the calculation here. So in particular, you're going to get the expected. So let me just delete all these notes. So the expected return would be the average of all this excess return. Okay, and also you will need to get the standard deviation of the excess return, and that's going to be pretty nice and easy. STDEV, and you select all the excess return. All right, I'm going to decrease the decimal a little bit. Okay, I'll adjust it, and the information ratio would be the excess return divided by the standard deviation of the excess return. Okay, so that's your result. And the last one would be the hardest, and this one is called a Sortino ratio. Okay, the Sortino ratio basically asks us to do the downside risk. Okay, downside risk. And you have a lot of returns here, and you need to know which returns are below the average. So of course you can first get the average return, and that's the expected. So we have been doing this for all the time, so you can use the average formula, and you get the raw return there. Hit enter. Okay, so that's the raw return. And for the downside risk, first of all, it's risk, so it's a standard deviation. Okay, it's a standard deviation, but the standard deviation only count those observations with the returns that are less than the 1.29 average. You see, this first return will be counted, the second will be counted, the third will be counted, because they are all below this 1.29, but this one is not. The fourth return is above that, and this return is also above that, so on and so forth. Okay, so before we do that, so let me just use this basic example from the textbook to show you how to calculate the downside risk. So right here you have two portfolios, A and B, and you have 10 years of returns. So these are the returns: -5%, -3% for A, and then -1%, -1%, on and on for B. And then you have this expected return needs to be calculated. So that's going to be the average of all the returns here. Okay, and then drag it. All right, and the standard deviation, the normal one, will be just the one cover all kind of risk, upside risk and downside risk, all get incorporated, all get included. So you use STDEV. This time you're going to use a P, all right, because we are assuming that this 10 years of returns are all the returns for the portfolio, because the portfolio only lasts for 10 years. So the 10 years is all the possibilities. Okay, and then you're going to drag it all the way to the right for portfolio B. Okay, and then you will need to get an indicator saying that whether the return is below average for A or above average for A. Okay, and so basically you're going to use the if statement. So if a given return is less than the average, okay, then this is below average. So I will use the number 1 here to indicate it's below average. Otherwise, if it is above average, the output is going to be 0. Okay, so this output is a 1 because -5 is lower than 4. So that's below average. So it should be 1. And if I drag it all the way, you can see these observations, they're all below 4, so the indicator is 1, and these observations, they are all above 4, so the indicators here are zeros. Okay, and then I'm gonna do it for B. Change the name, and I will use the same formula again. It's gonna be if statement. So if the best return, a given one, is less than the average of 4 right here, that's a different 4. That's for B. If it's less than that, then the indicator is 1. Otherwise, it's 0. Okay. Then I just double click. As you can see, that here are the indicators. Okay. Then to calculate the squared deviation, I need to use follow the mathematical formula. There's no short way of doing that. There's no shortcut of doing that. So what you do here is you're gonna get the deviation. So let me just put it here. So you're gonna use each of the return, okay, minus the expected return, and this is called a deviation. All right, and you're gonna take the square of it. Okay, I'm gonna take the square of it. It's gonna be called squared deviation. All right, and make sure the subtractor, the expected return, is locked. All right, before you drag it, and you can just drag it down. So that's the squared deviation, and then that's for A. Let me just name it squared deviation for A. And then we're gonna do it for B. Oops. This is for B. Okay. Double click here to make it long enough. All right. So for B, it is each of the returns of a B minus the expected return here. Lock it. Okay. Then takes a square of it. And then bang. Okay, and make sure it's only for it's only 10 years of data are observed. Okay, are retained. All right, and to get the standard deviation for the downside risk, number 1, you need to get the number of downside risk. So the count below average returns. All right, so how do you do that? You're gonna take the summation of that. So the summation of all the indicators here, it equals to 5. That means 5 out of these returns are below average. And then I drag it to the right. It also equals to 5. So for B, 5 out of the 10 returns are below average. Okay, so I need that. And to calculate the downside risk, okay, downside risk or downside standard deviation, so this is what I'm gonna do. So I will use the sum of product function. Okay, so I will use a sum, and I will use the indicator multiplied by the square deviation. All right, so if they are zeros, if they're above average, that means this square deviation will multiply by 0, so they will not be counted in the downward risk calculation. All right, after that, I need to divide it by the count of below average, or the number of returns that are below average. Okay, and this will be called a variance. I need to close it by taking the square root of this, of the downside variance, to get the downside standard deviation. Okay, and then this will be the number. Okay, and then I just drag it all the way to the right for portfolio B. Okay, it is pretty important to realize that you have the whole population here. So for the standard deviation right here, you should use standard deviation P, since all the 10 years are all the population you have for the data. Okay, but for this one, you get like 5 years of data, roughly 60 month or 58 month of data for this portfolio. Okay, that's a given portfolio return. But this portfolio lasts for, say, 10 years or 20 years, but you only are analyzing the 5 years. Then you would need to use the STDEV or STDEVS. And S stands for sample. Okay, it will be the same as STDEV, but if I hit enter, that will give me the same result as STDEV. Okay, you see it's always 8.82 no matter if I put a point S or not. And again, S stands for standard deviation. And right here, to get the downside risk, so we need to do some twist. And we're gonna put the indicator of a below average. And where is the average for this portfolio return? So it's already we don't have the average for this raw return of the portfolio, but we have the average of the risk premium of the portfolio. It's the same thing. Okay, it's the same thing. If you well, just to do this. Okay, just say the average return. Well, actually, we do have it. I apologize. So you have the average return here. So I'm going to use if statement. So I will compare the raw return against this average return, lock it. So if it is below the average, then the indicator equals to 1, otherwise 0 for above average cases. Okay. So right here you got a 0 because 8.56 is above 1.29. All right, and then I just drag it all the way down, and you will see zeros and ones, either above average or below average. And then you need to insert another column, and it will be called squared standard deviation. Okay, sorry, squared deviation. Okay, so you are going to use each of the raw return of the portfolio minus the average, which is expected. Okay, and that's called a deviation for a certain month of return. Takes the square to get square deviation. All right, and then just drag it all the way down. Okay, you can increase the decimal a little bit. And to get the downside risk, okay, to get the downside risk, you are going to count the number of below average returns. So count of below average. So you will need to take the sum of all the indicators. So 1 is they are below average, and 0 means they are above average. Okay, so it's actually from J2. I'm sorry. Okay, so 31 of them. Okay, 31 of these returns are above average. And then to get the downside risk, which is a Sortino ratio, part of a Sortino ratio, you will need to use a square root. Well, before that, you can do this as sum of a product function. Okay, so we just use a sum of product function. So you are going to use the column of this indicator multiplied by the column of a squared deviation. Okay, all right, and then the whole thing will be divided by this number of account, that's your n in the formula, minus 1. Okay, because it's a sample of you have here for the data. It's not the whole population, so you're going to use n minus 1 as a denominator. And what you have here is called the variance, and you're going to use a square root of the whole thing divided by this variance to get the standard deviation for the downside risk. And for your Sortino ratio, it is going to be the average expected return, okay, minus the average of the risk-free rate. So basically, that's the average risk premium. Okay, just put it here. All right. So once you make that subtraction, it will be divided by the downside risk. Okay, so this is your Sortino ratio.